Hi, and welcome to Friday Friends. I'm Amanda.
And I'm Carly, and we're Next Chapter Home Team.
1, 2, 3, 4.
Welcome to today's episode of Friday Friends. We're here with Liz Terwilliger of Amerifirst Mortgage. Thanks for joining us, Liz. Thank you.
Today, Liz is going to talk to us about what not to do when you've already gotten your pre-approval or you're under contract. But before we get into that, we were talking a little bit about some of the stuff that you like to do.
Yeah, so in my spare time, my fun time, I really enjoy staying active. So several years ago, I started practicing yoga, and I've really advanced in that area. And I also play a lot of tennis.
Have you always played tennis, or did it
No,
start
I
with-
actually just picked it up when I turned, just before I turned 40.
I played in high school,
Oh, yeah.
but then I haven't played since.
Yes.
And it's one of those things I would love to, but then I'm like...
No, you should.
Okay, 'cause
You
it's-
should do it.
Okay.
You can come with me sometime, too.
Okay, I would
Yeah,
love to.
yeah.
Yes.
Liz, let's talk a little bit about what not to do
Yes.
when you get your pre-approval and or definitely when you get in contract.
Yes.
Oh, for sure.
A couple key things that you definitely want to make sure that you don't do is you don't want to make any major changes with your credit. So you don't want to open any new accounts. You don't want to close any new accounts. In terms of your income, you don't want to change jobs or make any major changes with your income. You do not want to fall delinquent or past due on any financial obligations, any payments. And then you do not want to make any large deposits or purchases in and out of your bank account.
Liz, let's talk a little bit about why these are negatives. Why should our buyers not do these things?
Yes. So first, when it comes to your credit, what we try to tell people is the credit report we pull is good for 4 months. So we're not going to touch your credit report again within that 4-month period of time. However, we know in this market it's taking buyers longer to find a home. So there's a very good chance that your pre-approval is going to expire. So your lender will have to update your credit report. So when you do things like closing accounts, I know sometimes it sounds like a good thing, and long term it might not hurt your credit, but sometimes in that short term time frame it can throw your credit score off a little bit, especially if you close a really good long existing account. You kind of lose a little bit of that history that's factored into your credit score. So that's why you don't want to close anything. Opening things, you don't really want to do that for 2 different reasons. Same thing, sometimes brand new accounts are scored differently on a credit report or within the score. So a brand new account sometimes can actually be a little bit of a negative. So same thing, can throw your score off, can cause it in the short term to be low. Again, you just don't want to do any of those things. You want to leave everything status quo on your accounts, on your credit, just to make sure that it doesn't throw that score off. The other thing too is if you're looking at debt to income, if your lender has you pre-approved at a certain amount, they've based it on your existing debts. So if you go out and you open up new accounts, like new credit cards, new loans, car loans for sure, then suddenly your debt to income is off. You may not be able to get approved for what you originally were. We understand though that life happens. Sometimes people will call us and they say, hey, I need to get a new car, my lease is coming due, I need to trade it in. We get that. So I say, number one, if you can avoid doing any of that, that's the best route. If you need to, you always want to communicate with your loan officer before you do it. Not that we want to control everything in your life, but we just want to make sure that what you're doing isn't going to affect your approval.
Right, because you have to document everything,
Yes.
and those changes
Yep.
you have to make notes of.
Right.
So if changes happen, it's
Yes.
important to make sure that
You
the
let us
steps
know.
that the
Yep.
steps are taken appropriately so that you don't end up without a house or without an
Exactly.
opportunity to purchase a house anymore.
Exactly. Don't change jobs. It's funny how often you still have to remind people of this. They don't always get why that's important. It's like, well, a big part of your approval is based on your income. So job changes, again, same thing. If you can avoid it, but life happens and sometimes opportunities come along. We certainly don't want people to miss out on that. So communication is key. You want to communicate it to your loan officer, let them know, hey, I'm being offered a new position. Sometimes the job changes are okay. If you're salary and you're going to a salary and it's comparable or more, I'm going to tell you, go ahead and make that change. If you're an hourly borrower and we need to use, maybe you have a lot of overtime income and bonus income and then you're going to start a new job, I would say no, because now suddenly I can't use any overtime or bonus in your income calculations. And definitely do not want to switch from a salary or hourly, regular W-2 to any kind of self-employment. You need at least a 2-year history of that type of income So if you do that, then you're out for 2 years. So that's definitely why those job changes. So my initial short answer is don't do it, but if things come along, definitely just communicate it because it may be okay. Falling delinquent on payments. So same thing, we're not necessarily going to repull your credit report within that 4-month period of time, but again, if you need longer, then we pull a new credit report and then suddenly you've been late on a car loan. A recent late on your credit report has a significant impact in credit score. It can drop you 50 plus points. So suddenly you're approved and now you're not because of one late pay. And I know that seems minor in the grand scheme of things, it is, but the issue is it's impacted it so much because it was brand new. It just happened. Finally, it's the time to, really watch your credit like a hawk, make sure things don't fall behind. But the other thing to make sure of, and a lot of people don't think about this, are the items that don't show on your credit report. Your rent, your utility bills, items like those. Because a lot of first-time home buyers, sometimes you might have to prove your rent history. Especially if you're pushing the limits of what you want to get pre-approved for, or maybe you don't have a long established credit history. Sometimes a lender will say, well, let's get their rent history of what they've paid. And that rent history, a positive rent history, goes a long way. So definitely, even though you're thinking, well, that doesn't show on my credit report, still very important to maintain those items too.
Well, and same with the mortgage.
Yeah.
Continue to pay your mortgage. Like if you're a buy and sell and you're
Yes.
selling to buy,
Right.
and you miss that mortgage payment, that can have a huge
Huge
impact.
impact.
I actually lost a house
Yes.
before for someone. So
I
even though you're selling it, keep
make the
making
payments.
those payments.
And that's actually a very good point for sellers. I get this question fairly often. Well, we're supposed to close, let's say December 30th. Do I need to make my December payment? I say yes, make it, because they're going to get that money no matter what. Your interest is paid in arrears. So when you make December's payment, it's actually paying November's interest. So if you just don't make December's payment, when they get your payoff for closing, they're going to add in all that money anyways. So you're just going to get that much less money at closing, and then on top of it, you're going to pay a late fee. So you might as well just make your payment.
Right.
You're going to net out the same amount, and then you don't run the risk of making that late payment. And yeah, sometimes if it's a recent mortgage late, it can be a huge, huge impact to your credit. It can be a huge issue with approval. So the mortgage, all your debts are important, but I feel like housing payments are the most important thing to make sure are always on time.
Always pay those first.
Always.
Yeah.
You had mentioned with late payments how it causes a huge dip on your credit for like short term. How long does it normally last?
Typically, anything that happened within the last 12 months is going to have the most impact on your credit. It's hard to say because there's no exact formula. Everybody's credit's a little different. Depends on how long of a history. If you have a long, perfect history of credit with lots of credit, that late might not hurt you as much as a first-time home buyer that maybe only has a few items on their credit and they're all short. That's going to have a bigger impact. So depending on the overall credit history, recently, I usually say you have to give it at least 6 months before your score will kind of rebound. But always keep in mind the most recent 12 months impacts your score the most, all the activity in that.
One final thing not to
Yes.
do.
Oh, deposits. So, surprisingly, a lot of people keep cash at home. I never realized how many people like to keep cash at home. Totally fine, I get it. But you can't use it in a real estate transaction. The big thing is making large cash deposits into your bank account. So deposits are okay as long as you can prove where it came from. So same thing, sometimes you just have to give people really short advice. So I always tell them, hey, wait, don't make any large deposits into your bank account until you consult with us. Because we just like to explain what is fine and what's not. So cash is not something you can use. Has to be in your bank account for at least 60 days, so it has to season before you can use it for any sort of real estate transactions. Lenders always have to get 60 days of bank statements, so just always keep that in mind. If you were trying to use cash for your real estate transaction, we just simply can't source it, we can't use it. So you just always want to prep for that and just know keep your money in the bank. If you know you're getting ready to purchase a home in the next couple months, I say save your money in the bank. Sometimes people like to take the money out of the bank and save it at home. Keep it in the bank.
Or if you're getting ready to purchase a home, take that money and put it in the bank.
Get it in the
so
bank
that
and
you
let
can
it sit
see
there. Yes. Yes.
Or what if they have sold something recently?
Yeah, so sometimes those are okay. This gets a little complicated because there are some thresholds where someone can put a little bit of cash in there. It all depends on the borrower's income and things like that. So there's a little percentage of their income that is allowed to be deposited. So, and again, that's why we just tell all borrowers, just don't do it, call us, because you may be okay. Because sometimes people lend someone money and then their friend gave them their $200 back. Well, that's probably fine to put that in there. $2,000, no. So it's just things like that. If you sell something, it's incredibly important to document it. Same thing. I have a lot of people that say, I'm going to sell equipment.
I had one. He was selling a vintage car that he had.
Yes.
So, I mean, we're talking thousands of dollars.
Yeah. But you'd be surprised when people do that in cash. So I say, no, you definitely want to make sure, go to the bank with him, get a cashier's check, do a bill of sale, take a picture of the title. You have to show the paper trail of where that money came from.
Right.
So that's what we just try to explain to people, that it's like, if you just deposit cash and say it came from here, that's not a paper trail. We actually have to show where it came from.
So it's got to be in the bank 60 days.
Yes.
So if for some reason someone had sold something, had a lot of cash at home, and they're looking to buy in the future, as long as they put it in the bank and it's been there for 60 days before getting pre-approved,
Yes.
you don't need record of it.
Seasoned funds, and it's their money to use. So so keep that in mind. And again, I just try to prep people at the time of pre-approval. Some people will say, no, I save all my money at home, and it's like, we got to get it in the bank. So if you don't have another source of funds. Now, sometimes people have cash at home, but let's say they have a 401k or they have something else and they want to buy right away, or they can get a gift from mom or dad. That's fine. We'll just use those funds as acceptable, and then you can just keep your cash, So
now, if it's a gift from mom or dad,
yes,
you still need a paper trail of where
Yes.
that money comes from
Yep.
as well.
So same thing, no cash. So mom or dad, depending on the type of financing, your conventional financing is a little bit easier. Typically, we just have mom or dad write a check, and then we just need copies of the canceled check showing it came actually from their account. Your government-backed loans, like your FHAs and USDAs and everything, are a little bit more complicated. We have to actually get a copy of mom and dad's bank statement to show they had the money, then they give it to you, and we have to, do the whole 9 yards. So that doesn't always go over well with mom and dad.
Right.
You want my what?
Yes. So there's been many years, there's been some conversations, you can just give it to me. You don't have to give it to your, son or daughter to give to me. And we do remind people that even though we're a mortgage lender, we are a financial institution. So everything is private, everything is confidential, just like it would be for anyone.
So those are some great tips for our buyers if they're getting ready to get pre-approved or purchase a house.
Yes.
These are things not to do.
Yes.